The RBI has set October 1st as the deadline for lenders to shift to external benchmarks. Joining us right now on the phone line to talk about this is the CFO of Federal Bank, Ashutosh Khajuria. Mr. Khajuria, thanks very much for taking out the time. Obviously, this was something that was in the works for a really long time, and now the government has made it mandatory. How easy or difficult is the shift for you?
Well, I think banks are already preparing for it for last more than 6 months now. So I think gradually it will sink in. It was to start from 1st of April 2019, and then it was deferred in February policy or so. So I think, banks have already started, linking their liabilities first to repo rate or some other, market benchmarks. So this is a process which would take time to really stabilize, because this is basically changing the composition of the balance sheet itself and the pricing of liabilities first, because ultimately, banks do not depend more on the borrowed funds in interbank markets. So therefore, the transmission of monetary signal takes time. Almost 90% of banks' liabilities book as public deposits, and the remaining one is capital and reserves. A small portion, 2 to 5%, is borrowing. So this is the reason, why it was important first to look at the pricing of liabilities. And I think the largest bank took the initiative by linking the savings bank rates to repo rate. And therefore, gradually, external benchmark-linked loans would become the norm.
All right. So I'm assuming even those will be linked to the repo?
Either repo, or because the option is you can choose one of the four, you have four options. One is linking it to repo, or linking it to 3 months treasury bill or 6 months treasury bill, or any other, market benchmark for which the benchmark is published by an independent body, which is FBIL, Financial Benchmarks India Limited. So, which is a neutral body, and the risk of LIBOR type of thing where manipulation of benchmark could happen is ruled out.
Yeah. So, which one, according to you, from your bank standpoint, we were talking to KK Mistry earlier on, and he said, according to his view, it would probably look like benchmarking to the repo rate that most banks would go in for.
So I agree with him, because 3 months and 6 months treasury bills are more volatile than repo. So repo, and also if it is linked to repo, the complaint, or rather the markets disappointment of banks not being able to do the monetary transmission would also be ruled out, and even regulator would be happy with that. So no sooner any changes declared on both sides, liabilities as well as on the asset side, there would be a repricing happening. So I see repo to be the strongest candidate, though it may not be theoretically the most correct benchmark to link your loans with, because it's an overnight rate. It's an overnight rate, and your reset has to be once in a quarter. That's what, minimum once in a quarter. So you can't reset on a daily basis. I don't know whether banks would look at those products also, where they would be linking it on a daily basis. Because repo is a daily rate, and normally the change happens when the monetary policy review happens. But there is no such restriction. RBI may change it on a daily basis, or any day it wants to.
So when is the fastest do you think that this can happen, post linking the liabilities, and also not, when does it actually start to show up? And is this?
I think it's now regulatory direction that from 1st October banks have to go for new disbursals and all, and they would also offer the window to existing borrowers if they want to switch over.
Is that going to be difficult, the transition of existing borrowers?
I don't know. That would depend on, how aggressively banks take it, number one, and how aggressive the customers want to move to this one. Because this is not always in favor of the clients. Right now it's a rate cut and all that. And when the rates start moving up, it would be adverse for this thing. So this is not something which is pro-bank or pro-clientele or something like that. Right now we are just looking at from with one glass, and that is, rates are being cut, and therefore the, borrower should get a lower rate of interest. Think of the situation when rates start moving up. then I think there would be, more frequent upward movement of rates for, clients. So I just leave it there because I won't want to comment on that. This should be a choice which RBI has made that available to the clients to choose. So existing clients who have contracted earlier would have the full, right to, decide.